Liquidity risk management is a critical responsibility for institutional portfolio managers because the inability to convert assets into cash when needed can significantly impair investment objectives. Liquidity risk arises when an investor must meet obligations, fund expenditures, or satisfy withdrawals during unfavorable market conditions. Effective liquidity management requires understanding both the timing and magnitude of future cash requirements while evaluating the liquidity characteristics of portfolio assets. Institutional investors such as pension funds, endowments, foundations, and sovereign wealth funds often possess long investment horizons, but they must still maintain sufficient liquidity to meet operational needs. Consequently, liquidity management balances return generation with the flexibility necessary to satisfy ongoing financial commitments. A comprehensive liquidity management framework begins with identifying potential sources and uses of cash. Sources of liquidity may include cash reserves, portfolio income, maturing securities, asset sales, borrowing facilities, and derivative positions. Uses of liquidity can include benefit payments, operating expenses, capital expenditures, investment commitments, and unexpected obligations. Managers must evaluate both predictable and contingent cash flows when developing liquidity plans. Stress testing is particularly important because liquidity needs often increase during periods of market stress, precisely when liquidity becomes most difficult and expensive to obtain. Effective planning, therefore, requires considering adverse scenarios rather than relying solely on expected market conditions. Liquidity risk is closely related to the liquidity characteristics of portfolio holdings. Assets vary significantly in their ability to be sold quickly without substantial price concessions. Cash, treasury securities, and highly traded public equities generally provide strong liquidity, whereas private equity, real estate, infrastructure investments, and certain fixed income instruments may require extended periods to liquidate. Institutional investors seeking to capture illiquidity premiums often allocate capital to less liquid assets because they may offer higher expected returns. However, these allocations increase liquidity risk and reduce portfolio flexibility. Managers must therefore ensure that illiquid investments remain consistent with the institution's liquidity profile and future cash flow requirements. Addressing liquidity needs requires aligning portfolio structure with expected obligations and investment objectives. One common approach is establishing liquidity tiers within the portfolio. Highly liquid assets are designated to meet near-term cash requirements, while less liquid assets support long-term return objectives. This framework allows institutions to maintain sufficient operational flexibility without sacrificing exposure to higher return opportunities. Managers may also establish liquidity reserves, credit facilities, or contingency funding plans to address unexpected events. By matching asset liquidity characteristics to anticipated liabilities, institutions can improve resilience during market disruptions and reduce the likelihood of forced asset sales under unfavorable conditions. Institutional investors frequently face challenges arising from dynamic and uncertain liquidity requirements. Pension plans may experience unexpected benefit payments, endowments may encounter changes in spending needs, and foundations may face new grant commitments. Consequently, liquidity management is not a static exercise but an ongoing process requiring regular reassessment. Scenario analysis and stress testing help managers evaluate how portfolios would perform under adverse conditions such as market declines, funding shocks, or economic crises. These tools allow decision-makers to identify vulnerabilities and develop contingency plans before problems emerge. Continuous monitoring improves preparedness and supports more effective responses when liquidity pressures arise unexpectedly. Asset allocation plays a central role in managing liquidity risk because liquidity characteristics differ significantly across asset classes. Modifying asset allocation may be necessary when liquidity needs change or when market conditions alter the attractiveness of various investments. Increasing allocations to cash, short-term bonds, or liquid public securities can enhance flexibility and reduce liquidity risk. Conversely, expanding allocations to private markets may improve expected returns but reduce accessibility to capital. Asset allocation decisions should therefore reflect both return objectives and liquidity constraints. Successful managers integrate liquidity considerations directly into strategic asset allocation rather than treating them as separate operational concerns. Derivative instruments can also assist in modifying asset allocation efficiently. Futures, swaps, and other derivatives allow institutions to adjust market exposures without immediately buying or selling underlying assets. This flexibility can be particularly valuable when liquidity needs change rapidly or when transaction costs associated with asset sales are substantial. Derivatives enable managers to maintain target exposures while preserving portfolio liquidity and avoiding unnecessary disruption of long-term investment positions. However, derivative strategies introduce additional considerations such as collateral requirements, margin obligations, and counterparty exposure. As a result, derivative usage must be carefully integrated into the broader liquidity management framework. Ultimately, effective management of liquidity risk, liquidity needs, and asset allocation requires a holistic approach that balances short-term obligations with long-term investment goals. Institutions must understand the interaction between liabilities, asset liquidity, market conditions, and strategic objectives. Maintaining sufficient liquidity protects against forced asset sales, preserves investment flexibility, and enhances portfolio resilience during periods of stress. At the same time, thoughtful asset allocation enables investors to capture long-term return opportunities while managing liquidity constraints responsibly. By integrating liquidity planning, stress testing, contingency preparation, and dynamic asset allocation decisions, institutional investors can strengthen portfolio stability and improve their ability to achieve long-term financial objectives.